What's going on, guys? It's your boy Tyler, bringing you fundamental news on the bankruptcy case of SVB, Silicon Valley Bank. So, what happened to Silicon Valley Bank? Silicon Valley Bank was shut down in March 2023 by the California Department of Financial Protection and Innovation, based in Santa Clara, California. The bank was shut down after its investments greatly decreased in value and its depositors withdrew large amounts of money, among other factors. Bank failures like this have happened before. There were more than 550 banks between the period of 2001 and 2023. But this is but this one was particularly newsworthy. Not only did it come at a time when people already feared a recession, but it was also the largest bank failure since Washington Mutual closed its doors amid the financial crisis of 2008. To help you understand what exactly went down with the bank, we'll take a deep dive into the history of the bank, the events leading up to the collapse, what it means for depositors, investors, and the economy in general. What was Silicon Valley Bank? SVB, a subsidiary of SVB Financial Group, was the 16th largest bank in the United States. The bank had assets of about 209 billion in December 2022. Silicon Valley Bank provided business banking services for companies at every stage, but it was particularly well known for serving startups and venture capital backed firms. According to the company's website, 44% of the venture backed technology and the healthcare IPOs in 2022 were clients of Silicon Valley Bank. Why did Silicon Valley Bank fail? Silicon Valley Bank saw massive growth between 2019 and 2022, which resulted in it having a significant amount of deposits and assets. While a small amount of those deposits were held in cash, most of the excess was used to buy treasury bonds and other long term debts. These assets tend to have relatively low returns but also relatively low risk. But as the Federal Reserve increased interest rates in response to high inflation, Silicon Valley Bank's bonds became riskier investments because investors could buy bonds at higher interest rates. Silicon Valley Bank's bonds declined in value. As this was happening, some of Silicon Valley Bank's customers, many of whom were in the technology industry, hit financial trouble and many began to withdraw funds from their accounts. To accommodate these large withdrawals, SVB had to sell some of its investment, but those sales came at a loss of about 1.8 billion, and that marked the beginning of the end for the bank. Some people believe that Silicon Valley Bank's failure started way earlier with the rollback of the Dodd-Frank Act, which was the major banking regulation that was put into effect in response to the 2008 financial crisis. As part of Dodd-Frank, banks had to banks with more than 50 billion in assets would have to be put under the oversight and rules. But by 2018, Economic Growth, Regulatory Relief, and Consumer Protection Act signed by Donald Trump significantly changed that requirement. Instead of setting the threshold at 50 billion, the 2018 law increased it to 250. Despite being the 16th largest bank, SVB didn't have enough assets to be subject to the extra rules and regulations. If the threshold was never changed, SPV would have been more closely watched by regulators.